Interest rates are on the rise pretty much across the board, with negotiations for the US debt ceiling to be risen, showing some light at the end of the tunnel, and Canadian inflation numbers coming in a little bit higher than expected. Pretty much the bets across the board are rates are going to stay higher for longer, and therefore interest rates are on the rise, bond yields are on the rise, and subsequently mortgages are on the rise. And as of this morning, you could get a mortgage for significantly cheaper than what you're going to be able to get it for at the end of the weekend. In fact, some lenders have already increased interest rates by 0.35%. And I'm going to get into all the details and tell you exactly what you should be doing, especially if you're in the market for a home or if it looks like you're going to have a mortgage renewal coming up in the next couple of months. But before I get into it, do me that favor, hit the subscribe button and hit the like button so more people like you can see this video. And if you're in the market for a mortgage, make sure that you have all the information that you need by checking out my mortgage secrets book that you can get at mortgagesecrets.ca. All you have to do is pay the shipping and handling. Okay, so let's get into it and let's discuss the mortgage interest rate situation because it's a doozy right now. We've seen interest rates and more precisely bond yields increase substantially over the last couple of days. And by this time next week, the 4.59 interest rates, the 4.39 interest rates are going to be a thing of the past. Because when you take a look at what's happening with the bond market right now, well, this is the tale of the tape. You're seeing bond market yields up pretty much substantially across the board. Now, this is a 3-month chart. The last time bond yields were this high was back in March. And as you can see, as of right now, we've come off of 2.94% on May 11th. And in just a matter of 7 days, we're up to 3.35%. So that's basically a 0.4% increase in interest rates in a very short period of time. And of course, for those of you who watch the channel, you know that when bond market yields increase, so do 5-year fixed rates and fixed rates across the board. And as of this morning, a lot of lenders were at 4.59%. They've now increased their interest rates to 4.94% with virtually no notice. And like I said in the intro, by the end of the weekend, it's going to be highly unlikely that you will be able to find a mortgage in Canada for under 4.5%. Now, this is all happening because of what's going on partially in the States and partially with respect to what's happening with inflation in Canada. So let's take a look at what's happening in the States. Obviously, the debt ceiling is a big conversation, and that has an impact on bond markets all over the world. And it's affecting the Canadian bond market, especially as there seems to be some light at the end of the tunnel. It seems the debt ceiling is going to be lifted, which means an economic catastrophe is going to be avoided. And subsequently, that means that the chances of rates going down are going to be less, right? Because if there was an economic catastrophe, then rates would go down. Now that it looks like Republicans and Democrats are going to agree on raising the debt ceiling, well, the chances of that catastrophe are less, and therefore the expectation that interest rates will stay higher for longer is now in play. Subsequently, bond market yields increase. And even though this means higher interest rates, this is definitely very good news for the economy. And if you go and you take a look at the inflation numbers, which are also having an impact on this, we're seeing inflation numbers raise higher than expected, again, largely due to mortgage costs. Higher interest rates are leading to higher mortgage costs, which is leading to higher inflation. If you took mortgage costs and rents out of the equation right now, inflation would be down to about 3.6%. But because those two things are considered in the inflation numbers, we're actually up around 4.6%. Now, here's where it gets really interesting, because traders are now expecting that there's going to be a rally in the dollar, and they're also increasing their bets that there will be an interest rate increase in June. Now, about 30% of traders are suggesting that this is going to happen. The other 60% aren't, but it's making the likelihood of an interest rate increase in June by the Bank of Canada more likely. So we could be getting hit here not only on the fixed rate side, but also on the variable rate side if the Bank of Canada does make changes. And if the economic data continues to come in better than expected, we're probably going to see a hike sometime in the near future. So all those bets that interest rates were going to go down before they went up again, well, you can pretty much take those off the table because there's now just as much likelihood, at least in my opinion, that we're going to see higher rates before we see lower rates. And the evidence is now that you can't get that same mortgage that you could get yesterday for the price that you could have gotten it at. So what do you do? Well, first and foremost, if you're in the market for a mortgage, you want to make sure you have a rate hold in place. Now, you might still be able to get a rate hold at yesterday's rates, but you have to act fast if you want to get that. And there's a good chance that you won't be able to get it because the lenders and the brokers that are dealing with their existing clients are probably already at capacity, but it might be worth a try. But nonetheless, even if you can't get it, it is definitely prudent to make sure you have a rate hold in place, which means a pre-approval with all of your documents and fully underwritten with a rate and a lender submission attached to it. Now, obviously, when you get a pre-approval with a rate hold, the rates are higher than what the rate specials are at any given time. So don't pay too much attention to that face rate on a pre-approval because it's going to be higher, but just know that you have it as a backup plan just in case interest rates continue to go up. And again, it's really important here that you choose your mortgage wisely. Make sure you aren't getting a 5-year fixed with a big bank because they're going to have massive penalties. And if interest rates one day do come back down, that's going to prevent you from having the leverage you need in order to get a lower interest rate midterm. And also make sure that you're steering clear of the discount mortgages that have often punishing restrictions that also prevent you from being able to get the lower rates if they do start to come down. And if you want to know all about that, you can again check out my book, Mortgage Secrets, or you can go check out the Rate Secrets course, which gets you the information pretty much instantaneously. Oh, and if you want to know a little bit more about what the Bank of Canada is thinking right now, make sure you check out the video from earlier today that talks about the Bank of Canada and their worries with respect to homeowners going forward. I'll link to it right here.